Hello, ladies and gentlemen. Well, the risk dial did warn us that we were in a period of mild risk off, and equities did come off. Not that I'm paying too much attention to it at the moment. I think for the moment this is a growth scare, and it will not lead to recession because the data just does not support it for the time being. But what it does tell us, in conjunction with other indicators, is that we are likely to remain in a range and have some continued scares to the downside, maybe something like this period here, where we just sort of went sideways and worked off a whole load of excesses, and then we went again. It's very, very noticeable that the one sector which has always led the stock market higher, i.e. the tech sector, cannot get any kind of traction, and that therefore the likelihood of us powering ahead in the stock market is rather low. In which case we're looking at the risk spreads and we're looking for levels to enter and exit trades as opposed to anything that is going to be longer term for the time being. The big moves continue to be in the yield curve, and the disinversion is now official. We closed for the first time really below the zero line, and we are now at 6 basis points. And this basically suggests that we are going to get continued volatility in other asset classes while the yield curve normalizes. Now, the yield curve being positive is the most normal thing in the world. It being negative is the abnormality. And where should the yield curve settle? Well, I would have thought that this kind of area between -20 and -12 is where the yield curve should settle for the time being and not go any further. Now, when I do negative numbers, it's because it's the 2's minus the 10's. So this is a positive curve. So my negative numbers are positive curves, and positive numbers are a negative curve. But this is the kind of area that I would expect it to reach and to remain at and not go much further than that. What I think is going to change in the next few weeks is that people will no longer be buying the belly. The belly being the 5-year area. I've been telling you that I'm long of 3s, I'm long of 5s. I'm going to exit those positions. I don't think it makes much sense anymore because the 5s have led, and if you look at something like 5s, 10s, it's getting to this kind of level where it's very unlikely that it's going to go much further with any speed. And if we look at then 5s, 30s, we are already in the area or very close to it that I would consider a normal part of the curve, i.e. something like 60 to 65 basis points difference between 5s and 30s is the normal. And I would not really be looking for the 5-year area to lead anymore. I think the belly has done everything it needs to do more or less within 10 basis points, and that the normalization of the curve is close to over. Before we look at the individual tenures, let's have a look at real rates. So this is real 10s, and we're basically around the 168, 167 level after this doesn't have Friday in it. I don't know why they don't update it immediately after the end of the day. But what do I think that we're going to get? I think we're going to get rates around the 1.5% area, oscillating from 185 down to 130, something like that. I don't think that we go below 1. I think it makes far more sense to have a period until we find out what the economy is doing with the lows just below 150. And that to me would indicate something like the 10s around the 375 to 385 area being towards the bottom of the range. So let's have a look at the individual 10 years, bearing in mind that yields can stay around the 1.5% area for quite some time. So let's start with the 10s. And really, my analysis, my fundamental analysis says that we are in a period like this. I think that the 390 area is going to be about 390 to 399 is going to be the high. And this kind of area, 342, is going to be where the yields are drawn towards over time, but they don't really go through it. I don't think that inflation is going to fall off a complete cliff. I think it will return to target, and especially given what commodities are doing, and that will encourage real rates to go down towards that 1.5%. So 1.5% on completely normalized CPI and PCE at 2% is around the 345, 350 area, and that is where the bottom of this move in the 10s should be. I don't think the yield curve will steepen much more than another 10 basis points or so, as I told you. So what is a reasonable level for twos? Because twos at the moment have got the bit between their teeth. And as I always tell you, don't get into the way of twos when there's a cutting cycle. I think that they can reach this 342 area without any problem. But it's going to be very, very difficult for them to start going through there. I think a period of sideways after that is very likely. The one I'm beginning to like least is the 5s, because I don't think they really have much more upside than this kind of area around the 325, 328 area. I think 2s, 5s are disinverting themselves, and they are still at 16, and they are going to go to this kind of area around 0, and eventually they're going to go down to this kind of area, which is a small positive. So to me, the 5s are beginning to look as the least attractive, although, as you can see, they have led a long way. They have gone basically from this 486 all the way to 345, and they have led as the belly tends to. But when the belly gets stuck, then you should be doing barbells. You should be long of 1 year, 2 year paper, and you should be long of 10 year, 30 year paper, and let go of your holdings in 5s. They've done their job. Their duration has made you money. It's now time for the income in fixed income, i.e. the very short end and the longer end, which is going to provide you with the duration should we transition from a growth scare into some kind of a recession. But I think that that is still very, very far away. The German curve is disinverting too. This is 2s, 10s in Germany's, and I think that eventually will hit this -12. We're still 5 basis points inverted, but I think that eventually we get to this kind of area, -12. The German market is very, very quiet, as you can see. We are very, how shall I put it, going nowhere. Really, we're in the same range that we have been for a month, and we're not breaking out of it. It's all about the US, and the Europe is doing absolutely nothing, and I think will continue to do absolutely nothing. I think every time we get to the 200-day moving average, they're going to be buyers of bunds, but that's about it. I really can't see that this market is going to do anything at all but normalize on the yield curve. So the 2s 10s, the 2s 30s, and still the 5s 10s are going to go down to this area, and once they've reached it, that's that, and we are in a sideways period. What does that mean? That the ECB cuts, but it's a hawkish kind of cut, and the longer end of the market really goes nowhere, because inflation, once it got to 2%, the only thing that really can move is what? And the yield curve is positive, so you have a very narrow, very limited range of real rates here. The real rates, the meat of the real rates is in the US, and the US has a lot more issuance, and real rates there should be higher. But what I'm trying to say is that I really can't see the attractiveness of buying bonds. I can't see the attractiveness of buying the French market. I can see some attractiveness in buying the Italian market because you're getting a lot of pickup, and the yield spread against Germany is quite stable. But that is about it. I really see very little attractiveness in doing anything in Europe, and therefore I think that spreads still narrow between the US and Europe. If you look at 5s between US and Germany, you can see how far they've come and that they're beginning to get support. And this triangulates with my view that 5s in the US have done a hell of a lot, and it's about time they stopped. And the belly can come back and not be so attractive anymore, not against 2s and not against 10s. Compare this 5s to the 10s. The 10s could be down here, and they're not. They're, something like 20, 25 higher than they would be. To me, the attractiveness lies now in the 10s, or even in the 30s, not so much in the 5s or the 2s anymore. So I'm still bearish for this. I think it will come back and you'll see 165, but eventually it's going to go down here, this kind of area, 130, 133. And that tells me that a barbell approach in the US is the right approach to have. I own the very short end, something like 1 year or floating rate notes or whatever, and also own the long end and abandon the belly. Now on Friday we also had Williams and we had Waller making their comments before the Fed goes into the blackout. So we won't hear from the Fed officials again until we see the announcement from the FOMC, which we already know is going to be a cut, and the question then becomes, is it a 25 or is it a 50 cut? I personally think it's a 25 because I don't think there is any panic in the numbers. The question then becomes, is this a growth scare or is this the beginning of a recession? Right, so every time the yield curve disinverts or threatens to disinvert, people start talking about recession. Why? Because the few data points that we have always coincided with either a recession or a soft landing. Soft landing, much less, because it's much harder to achieve than a recession. Now, whether the recession is deep or not is a technical question, but it's defined as a recession if we have 2 negative quarters of growth. That is why people start panicking when you get the disinversion, and I think it was almost automatic that people would sell risk assets on a disinversion in the 2s 10s. they would also buy options to hedge, and that is perfectly normal, almost automatic behavior by asset managers. Now, the big question becomes, as I said, is this a growth scare or is this recession? Because this is the butterfly Z4, Z5, Z6 in the sofas. If it's a growth scare, it comes right back. If it's not, it keeps on going. I think it's a growth scare and it will come back. To me, the curve will normalize somewhere around the 3 to 3.25 area in Fed funds. I don't think it's going to be that fast, and I don't think the Z25s are the place to be, because they are basically the lowest point in the curve. The difference between Z5 and H26 is like 3 ticks, right? I don't think that that is likely to remain. I don't think that the Fed funds will be below 3%. I think the Fed will make it quite clear in its September dot plots that it's going to be still very data dependent, and unless the data starts showing real recessionary tendencies, and we haven't had a single number that shows that, I think that it's far more likely that we come back to this kind of level, 75, than we continue going down in this butterfly. Having said that, this is the trade that I prefer. Now, this is U 2025 against Z 2025. And here is my logic. We either will go into a recession or we won't. If we go into a recession, the curve will be positive, and it will be positive between U and Z for sure. At the moment, as you can see, the spread is negative, and the spread will be up here somewhere. I mean, well over 15. And if a recession is going to happen, it's going to happen by the first quarter of next year. If there is no recession, the curve will go positive again, because why would anybody be paying through Fed funds terminal rate? If this is a growth scare, we go to a normalized positive curve. If this is a recession, we also go to a positive curve. I don't see the possibility of this spread staying very negative for very long. And since we are, 8 basis points from the low, I think it's far more likely that on any dip you buy it and it ends up well above 15 in several months' time. To me, this is much more riskless trade than the butterfly. And I think this spread makes 0 sense at negative. And I will be putting a lot of it on, because the risk is so small and the reward potentially so large. I can't see any scenario in which this spread stays negative. I just can't see it. The DXY has basically been doing exactly what I thought it would do. I said 101.90 as the high, and here we are, 101.91. And to me, this is the absolute level that it will not go through. And I don't think the odds are that we even retest it. You can see on the weeklies that the Bollinger Bands are here and the 200 period moving average is here. So I would have thought a period of sideways to up towards 102.85 is more likely than not. And that also tells me that we are in a period of stability in the bunds versus the 10-year relationship. That 152 level is going to be very difficult to break convincingly, and that we are going to go sideways before we go down. I just can't see that this is going to continue down at any speed. And if we change that to a euro chart by itself, we can see that we have all these Bollinger Bands on the weeklies. It's going to be very, very difficult, but any dip down towards the 109.30 area is going to get bought, and eventually we go. So probably a couple of weeks of sideways to maybe down to this 109.50-30 area, but that's, and do an ABC retracement, but that's about all I can see in terms of dollar strength for the time being. I don't think it will be very propitious. Down here, I would be a buyer of calls. Having done an ABC, we would be looking for that to break 112 and retest 113 within a month. The big news in DBC is that we have broken the 2175 level, which also was the low for the year. And we were there, as you can see, in February and March. It is a worrying development, but I don't think it's terminal just yet. I think we might have 1 or 2 weeks of sideways, but eventually I think we trade this kind of level, which is about 1950, and that is several percentage points lower in everything. Now, that is also a very good reason why I think that it's probably time to move out from the belly to the 10 to 30-year area. What are the odds that inflation picks up here? I think they are now minimal if we are going to go to this area and this is the beginning of 2022 in terms of prices. If that is the case, have a look where bonds were at the beginning of 2022 and have a look where real rates were at the beginning of 2022. It just makes sense to me that bonds are normalizing, either because inflation is going back to target, and this chart would argue that inflation is going back to target, or we're having a growth scare, or we're having a recession, or we're having a combination of all three. Well, none of those are bearish for longer duration. The belly has led, we got there, time to abandon the belly and buy some longer duration and hold it. You get more yield, you don't have that much more risk during a period of disinflation, and that makes sense to me that we will trade down here to 1950 over the course of the next couple of months, and that should be supportive for bonds and especially longer duration bonds. Why would you want to buy stuff which is already discounting below 3% terminal rate in Fed funds when you can buy stuff which is trading at 4% and 170 real? Gold DBC seems to be entering some kind of a acceleration phase as well, and it's not unreasonable to think that it could trade all the way up to here around the 13 area, and given that we're close to 11, I mean that's in percentage terms a very big move, and would indicate to me that gold is going to do nothing, i.e. go sideways, while DBC eventually takes the brunt and goes down to below 20 in around that 1950 area and meets those targets. So this chart is definitely telling you that on any pullback you want to be owning gold over commodities. I want to start the equity overview with the NQ, because what is becoming increasingly clear is that the tech sector is refusing to lead. When the tech sector refuses to lead, I think it's almost impossible for the SPX to start making new highs. And here we have the absolutely critical level for the monthlies is going to be around 17,800. Where do the Bollinger Bands and this moving average come in for the weeklies? Well, they're going to come in much at the same level within, whatever it is, 1%. This is 17,600. And this is the 195-minute chart, which splits the trading day into two and gives me more information. But what this has done is failed to fill this gap that the SPX did fill. And now it's breaking down, and it's breaking down below the 200-day moving average, 200-period moving average, which is still pointing up, which tells me, not everything is lost, and it's way below the Bollinger Band. So I think Monday, Tuesday, we could get some kind of a squeeze up, but then I think it becomes critical again. So let me give you my thinking about equities and what happened last week so that we are more or less on the same page. And I lost money last week on equities, but I made it back on bonds, so I'm overall not unhappy. I was frankly surprised how violent the moves down were on Tuesday, because I didn't think that any of the data that we had that far was really weak. And I still don't think that any of the data that we've had is that weak. This, to me, is a growth scare, but also seems to be a period of very heavy rotation away from tech for whatever reason, and I don't necessarily think it's anything to do with rates, and into more defensive stocks. Defensive sectors like XLV or utilities. So there's a lot of rotation going on because there's a lot of uncertainty going on. And as I keep on telling you, every time the yield curve disinverts, it's a buy volatility signal. And when you buy vol, almost automatically you are in effect selling equities. And this is what's happening. But in the tech sector, it's happening also because of the rotation. And that is impacting it much more than any other sector. To me, if it starts going through this 17.5, 17.6 level, then the whole stock market is in real trouble. And then probably this is your target, 16,300-ish is your target. I don't think that that is imminent, but I am very aware of the possibility. Let's have a look at the clean chart, XPX, and see where the value is. We still have this gap here. I would have thought that value is going to be between this 52.54 and 53.27. I don't think that we can go much lower than that next week, and I think that that is going to be a decent level to buy some call spreads. I certainly will do at 50, 52, 55. To me, there's very little likelihood that next week we go any lower than that, and that's because of the spreads against the governments. And here is the spread ITOT over government. I think that next week, if we retest this kind of area just below the 200-day moving average, that will be the bounce point. Next week we have the auctions in 3s, 10s and 30s. 3s will be no problem. 10s and 30s will probably back up the market a little bit but I think that they will go well as well, and that should give equities some confidence and get them to bounce a little bit. What we did on Friday was basically a little bit of a panic move because we're afraid of what's going to happen in Japan on Monday. I don't think that much will happen, and therefore if we see those levels that I mentioned just now in the SPX, I think its bounce time, and we can return probably to somewhere around here, 509, 510. I very much doubt that Japan is going to have a nightmare on the open, but if it does, this is kind of level that I want to buy, and I'm leaving a bid at 33,850. Right or wrong, I'm either going to get filled or nowhere near. I think the risk reward there is pretty damn good. This is where we opened the year, and I doubt very much that we're going to go negative for the year in Japan, simply because I don't see the reason. The tightening that they're doing is so gradual, and it's going to be so small that to have stocks go negative for the year, I don't think makes much sense. So that is the level where I'm buying them on overnight, and let's see what happens. A final word about volatility. It's perfectly normal after 1 or 2 weeks since a spike to have another move higher in vol. Unless we start going above 30 and closing above 30, I am absolutely still in the camp that this is a growth scare as opposed to the start of a recession. I know that all the spreads are negative. I know that the defensive sectors in the equity market are being bought against the aggressive ones, but I don't think that that is necessarily a sign of recession. I think that that is a sign of a growth scare. And really, volatility is now going to be my guide. If we start going above 30, I have to abandon my position. I don't think it will, though. I think the lower levels will catch the equities, and we will still get brutal rallies in equities that convince people eventually that all we're doing is we're working off very overbought levels in equities and in spreads against XLK and so on, and that we need to basically go sideways for a little bit with the uncertainty about the elections, etc., but that does not necessarily mean that we are entering a recession. And with that, I've updated all the levels. What I'm thinking is that the disinversion is practically over. That we're getting to levels where the 2s, 10s are not going to go much more than another 10 basis points. We're getting to levels where now 2s, 5s should really start disinverting another 10, 15. And that levels that make no sense to be long of the belly in, but rather look to buy levels in 10s and 30s, because you'll get more yield and more stability there over the course of time. I think I will probably be a buyer of 10s at the auction on Wednesday, and I will be getting rid of everything I have in the 3 to 5 year area probably first thing on Monday morning. Nothing is going to happen in the European markets, and that gives me confidence that any kind of a big dip in XPX, NDX, less so, but especially in the Nikkei, is a buy around this 34,000 to 33,800, because the market did a lot of work last week, and it did a lot of work out of fear. I don't think the VIX will spike anymore. It might go another 1-2%, but I don't think it really goes through. And the thing to avoid now is DBC. If we cannot recapture this 2175, then we are definitely going down to at least 2050, but most probably 1920, 1930 is not excluded. So here I've also added a YouTube little video from Double Line explaining what happens during disinversions, And this is the thing that actually, not that it worries me, it actually makes me more confident that we are not going to get a recession, because everybody is now looking for a recession on the back of something which is perfectly normal, i.e. a positive yield curve. What the positive yield curve does, it brings volatility, because people have, or they automatically change asset allocations. But that really does not mean that we're going to go into recession. I could be wrong about that, but I want to see data which convinces me that I'm wrong about that. But even if I'm wrong, if you're long of 10s and 30s instead of 5s anymore, well, you'll still profit. Thank you very much indeed, and I'll tweet you tomorrow.